Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
I'm your host, Erin Allen with BMO ETFs. And today we're going to talk about a popular investment approach that I'm sure you're all familiar with, and that is dividend investing. And we'll walk through some important considerations when you are evaluating all the different options out there for you. And we'll talk about sort of how to measure a dividend in terms of sustainability and growth. We'll touch on the basics and really why investors are flocking to a dividend approach. But before we get started, a quick reminder that we're not providing you any investment recommendations or advice today. This channel and this video is all about providing education to Canadian do-it-yourself investors. Before I introduce my guest today, I do want to introduce a very important update from BMO ETFs. So we have just launched this week a full suite of ETF-focused tools on our website. Not one new tool, not two, but 8 new tools ranging from an updated comparison tool, a screener tool, a largest and most liquid tool. The list goes on, and I won't get into them all right now. You'll have to go check them out yourself. You can either look at etfmarketinsights.com or bmoetfs.com. I do plan on doing a video to dive into these a little further in the future to give you a proper introduction. But check them out, play around with them, and send us your feedback on what you like and what you don't like. I think this just speaks to how we are leading in terms of providing high quality education to Canadian do-it-yourself investors, but also tools to allow them to go out and scour the entire Canadian ETF marketplace to find the right solution for them. With that, Tony, welcome to ETF Market Insights. Tony's been a guest many times before, so I feel like he doesn't need an introduction, but I'll give him one anyways. He is a index investor, a proponent of index investing. He graduated from Columbia University with his master's in risk management. But you would know him as a journalist, as a writer. He writes for many popular publications, The Motley Fool, The Street, Benzinga, and many across the border in the U.S. as well. I think his work is really straight to the point, direct, easy to digest, and that's why the do-it-yourself audience really is attracted to his writing style. So thanks again for joining us today, Tony.
Thanks for having me, Erin. Great to be back.
Let's dive right in. I'm hoping you can give us sort of an overview in terms of what is the benefit? Why are people flocking to dividend ETFs rather than just doing it themselves?
So there's a couple reasons here. The Canadian dividend universe is pretty popular. They're tax advantage, right? Especially if you're in a non-registered account, but the payout frequency leaves much to be desired. Aside from a few royalty trusts and a few occasional companies out there, most companies pay quarterly dividends. So if you're looking for monthly income, that's a little too lumpy for your needs. By combining it into an ETF, the ETF manager is able to smooth out these distributions and usually offer a monthly payout that is much more predictable. So if you're withdrawing for income, that can meet your needs easier. The other reason is that, even if you're a prolific stock picker, it's really hard to manage more than half a dozen positions. You have to determine how much of each to allocate, what to do with the dividends you receive. Do you reinvest in the same stock? Do you put in a different stock? How often you rebalance the portfolio? It can quickly get overwhelming, and then it leaves people subject to analysis paralysis. And when you consider all the implicit and explicit costs of trading from the bid-ask spread to outright commissions, paying an ETF manager that 30, 40 basis points a year to manage this on your behalf is much more economical in most cases.
Yeah, and I think the whole diversification argument is huge too. And if you think about if you're trying to recreate an entire market with a dividend approach, how many stocks you'd actually have to buy across the different sectors. And having the ETF do that in one ticket is pretty powerful for such a low cost. And that explains why there are over 100 dividend ETFs here in Canada. No shortage of them for sure, but there are a lot of different approaches that the different ETF providers take. So can you sort of give us an overview of what's available out there?
Yeah, sure. So you have the three usual approaches. You have dividend ETFs that track indexes. So, for instance, S&P has a lot of, say, the S&P 500 High Yield Dividend Index, the S&P 500 Dividend Aristocrat. These are an external methodology-based benchmark, and the ETF just tries to replicate their holdings, either by sampling a majority of them or simply buying each one in the right proportions. On the other side, you have managers that completely select their own stocks using an active approach, and that's based on their proprietary research. Some of these can be a bit of a black box because they don't want to give away their strategy, but generally you see higher costs, but you might see a smaller, more high conviction portfolio with greater active share, which is how much the holdings differ from a benchmark. And then somewhere in the middle, you have proprietary rules-based strategies, and that's what I see with the BMO ETFs, is that they're not quite indexed, but they're not quite active either. They're somewhere in the middle. You use your own internal framework, and that just leaves you with more flexibility to make modifications if they're needed, because as we know, dividend companies can change. But 3M just cut its dividend for the first time in nearly 60 years, and nobody saw that. But if you're beholden to an index, you kind of have to deal with that until the next rebalance or reconstitution.
Yeah, that's important. And I think there's also different approaches, right, in terms of dividend payers, that are just focused on the highest yielding names versus dividend growers. So looking under the hood, definitely super important. But can you touch on sort of why it would be important for an investor to look at not just the sticker price, the sticker yield or the dividend yield, but more in terms of along the lines of the growth and the sustainability of that dividend?
Yeah, absolutely. So it's important to note that the dividend yield you see is not just a function of how much income the company is paying, but also the recent share price movement. So sometimes a yield may appear deceptively high because the company has suffered a deterioration in its fundamentals and the share price has cratered. So we saw this with a lot of real estate investment trusts during COVID, where the yield skyrocketed to maybe 6, 7, 8, some even 10%. A lot of these were in commercial real estate and also retail. Now, a lot of these REITs ended up cutting their dividends. I think the most notable example of me was a RioCan, right? Big retail real estate investment trust, highly popular, ended up cutting its yield. So when you focus solely on dividend yield, it's a very myopic strategy. There's no guarantee that the high yield is going to last, and there's no guarantee that the company is generating the necessary cash flows to support that yield. I think some other important metrics to consider are what I call the three pillars of dividend investing. Of course, you have high yields, which you can use to screen for value, but you also need to look at dividend quality / sustainability, which is how well can that company maintain that dividend under financial stress. And then the third one is dividend growth. Has the company been increasing its dividend at least faster than the rate of inflation? So if you can target all three of these pillars, you're generally in a better spot than just focusing on one.
And then let's talk about sectors a bit, because another thing to look at in the methodology is, does the ETF have a sector cap? Because they can end up being pretty overweight in certain sectors. But talk to us generally how that might look in maybe the Canadian market and the US market in terms of sectors that might end up being overweight.
Absolutely. So it depends on which pillar you focus on. And this is something I urge people to really look closely at. If you just use a high yield dividend strategy, you end up with exposure to sectors that have historically paid above average dividends. So these include financials, energy, and utilities. But you also underweight some other sectors that may not have high yields, but have grown dividends at a historically higher rate. So when I think of dividend growth companies, two of them that come to my mind are Microsoft and Apple. Very high historical dividend growth, but they won't pass many dividend investor screens because the present yields aren't that high. And I think that's a very short-sighted way of looking at it. Ideally, if you construct a dividend portfolio in a way that emphasizes all three of these variables, you should arrive at what is approximately a sector-neutral approach, which means that although your portfolio focuses on dividends, the sector composition in the aggregate is similar to a market cap weighted benchmark index. And I think that's a great way to minimize risk overall and then really generate any potential outperformance from your picks instead of, say, a sector overweight.
For sure. Good points. And when we think about dividend as a factor, we always talk about it as being a more defensive factor. So we see a lot of people flocking to it tactically in times of market volatility or economic slowdowns, but talk to us in terms of how that performance has looked sort of across market cycles.
Yeah, sure. So I think the prime example of this was 2022, where in the aggregate, most dividend strategies fell far less than a market cap weighted one. And that's just because of how most dividend ETFs are weighted. They're fundamentally weighted. They're not weighted based on how big a company is. So when a particular section of the company, such as like 5 or 6 of them in the top driving performers don't do well, you suffer less there. Now, the other side of that is you will give up some upside in a bull market, but just as what we see with low volatility strategies, sometimes the most important part is minimizing that volatility and minimizing the drawdown. And when you screen for high dividend yields, you inadvertently actually provide exposure to the value factor, because there's an old strategy out there called the dogs of the Dow, where you screen each year the top 10 highest yielding stocks in the Dow Jones. And the high yields are sometimes a precursor to value. It's not always indicative, but it's a sign that you should probably take a closer look. And it's the same thing when you look at dividend sustainability, right? If a company's paid dividends for a long time and its payout ratio is reasonable and is well covered by its cash flow, it can be a sign that the company is investing conservatively and has robust profitability. And we see this with a lot of the large U.S. consumer staples giants that are dividend kings. They've paid dividends for 50 plus years. Just a few that come off the top of my head include Coca-Cola, Pepsi, Procter & Gamble, Colgate-Palmolive, and Johnson & Johnson.
Walk us through the BMO methodology in terms of how that works.
Yeah, so BMO uses that middle ground I spoke about earlier, that rules-based portfolio construction. It's not active, but it's not based on an index either. So it starts by looking at either international, Canadian, or U.S. markets, depending on which of the 3 BMO dividend ETFs you're looking at. And the universe is open to large, mid, and small cap companies, but we see that they generally tend to be more large and mid cap. Now, importantly, it excludes real estate investment trusts, because these, like the payout rule for them, the 90% requirement for the U.S., makes them a little bit different than your average dividend stock. And of course, we want to take out preferred shares. Now, it's then subject to a preliminary screen that looks at the stock's 3-year dividend growth rate. So it has to be either positive or flat. And then we sort the companies from highest yielding to lowest yielding. And the important thing to look at is the 3-year dividend growth rate. BMO chose this period because it doesn't react to like short-term declines, right? It's a more representative picture of a company's immediate and near-term dividend prospects, as opposed to just what happened like just a few days ago. And then we go on to the dividend sustainability screen. So we look at payout ratio, which is the dividends divided by operating cash flow. And the sustainability screen that is implemented screens this over the past 5 years. And there's an internally developed method that kind of grades them into 5 different buckets. And they get a score from 0 to 5 based on that forecast year and a weighting factor that assesses, the trend of the payout ratio and the recent history. And it also assesses stable earnings, right? Generally, you want companies that don't have wild fluctuations in their earnings because, that translates directly into volatility for your holdings. And then finally, the yield weighted. So you, instead of emphasizing just the biggest companies, which is a mistake I see some dividend ETFs make, they go through all this trouble and then they end up weighting the holdings by market cap, or worse, equal weighting them. The BMO ETFs use a fundamental weighting methodology, which is based on, exactly how much in cash dividends are coming out.
Yeah, we use that dividends available approach, where it's basically the yield of the company by market cap. And that really just helps reduce that value tilt and capture more capital growth in the portfolio. I think gives you more exposure to those market leading companies. That's why we see some of those, Microsoft, as you mentioned, Apple in the portfolios. I think also important to note the security cap is 6% and the sector caps, differences based on the geography, but in the US it's 25% per sector. And then in Canada and the international, it's 40% per sector. So just giving you some guardrails there as well. To keep the portfolios in line. What are some of the top holdings that investor would expect to see in these portfolios?
It would depend on the ETF. So if we look at the US one, there's a lot of names here that will be very familiar to you just because of how much of a brand presence these companies have. Right now, I'm looking at Apple, JP Morgan Chase, Procter & Gamble, Microsoft, Johnson & Johnson, Chevron. And this is something that I don't see in a lot of dividend ETFs. Your average high-yield U.S. dividend ETF will not hold something like Microsoft or Apple, simply because the yield isn't high. But in the BMO ETFs, these historically strong performers are in there because their dividend is very sustainable and it's grown at an above-average rate. Now, moving on to the Canadian one, you have the usual culprits. You have all the banks. You have RBC, TD, whatever. You have the pipelines like Enbridge. You have some of the largest oil and natural gas producers like Canadian Natural Resources. But one interesting one that I see is Canadian National Railway. Duopoly has super high ROE with like great operating efficiency and double-digit margins. But again, you don't see it in a lot of high-yield dividend ETFs like the ones tracking the TSX high dividend yield composite, because it doesn't have a high yield. I think it's just over 1.2% or somewhere around there. So a lot of dividend investors, by focusing on yield, will miss out on this gem, despite the fact that it is such a robust company. And then when we move on to the international ones, a lot of investors neglect international developed stocks. And I think that's a mistake, because you get some like really good names here. You get in ZDI, you get Nestle, you got Total Energies SE, which is one of the biggest integrated oil super majors in Europe, but also with a big renewable energy focus. You have LVMH, which makes all the luxury brands, has been surprisingly recession resilient. You got Toyota, which is probably the most important automotive manufacturer. Sorry, Tesla. And you also get access to some multinational miners that, shore up some of the weaknesses we see in the Canadian mining sector, giants like Rio Tinto and BHP Group.
Awesome. Thanks for that, Tony. So that sort of covers off dividend strategies. I want to talk a little bit more about some of those more complex dividend strategies that look to really enhance that cash flow, that monthly cash flow, make it even higher, still with the dividend focus. So walk us through some of these strategies and how they might work.
Yeah, so these strategies, they're not a free lunch, but they're a way to redefine your expected risk and return relationship. So I'm going to use the example of ZWC. ZWC is basically ZDV with a covered call overlay on it. It has a fairly similar portfolio, subject to more or less the same rules, but it uses a derivative strategy called a covered call, which in very simple terms, it converts the upside capital appreciation potential you see into a higher than average immediate income stream. So essentially you're saying, I'm not going to get this money further down the line. I'm going to choose to have most of it right now. So these strategies will appeal to people who are looking for above average monthly income that is above and beyond what you'd expect from the dividends themselves, right? And it's also fairly tax efficient as well. Otherwise, if you're going to be reinvesting the distributions, this isn't something I would use for that, because, well, if you're not taking out the income, why would you look for it in the first place? But if you are looking for that income potential with exposure to a very similar underlying portfolio, these are the kinds of strategies to look at. And of course, from some other providers, you also have leverage strategies. For instance, you may find an ETF that leverages, that holds all 6 of the Canadian dividend stocks in the banking sector, and then borrows cash up to, say, 25% of the portfolio to also redeploy there. And what that does is that it magnifies your yield and it magnifies your upside, but keep in mind that your downside is magnified as well. So these are better suited for a high-risk investor who is willing to see the value of their investment fluctuate up or down more for the chance at outperforming a non-leveraged investment.
All right. Thank you so much, Tony. So definitely, whether you're looking to use a dividend ETF as the core of your portfolio or as more of a tactical play, tons of benefits to this approach. But I think it's obvious that we definitely have to dig in and really look under the hood and understand the methodology, because 100 different ETFs on the market, all doing it a little bit differently. So make sure you're going to that provider's website and getting the methodology paper down. We have a detailed overview on etfmarketinsights.com, or you can get it on BMOETFs.com as well, which you should definitely download and read if you're considering investing in our dividend ETFs. So thanks again, Tony, so much for this insightful discussion. Hopefully we'll get you back on again soon.
Absolutely. It was a pleasure.
All right, that's all for today. This next week, we're going to be doing our regular quarterly bank earnings report podcast. So you can look out for that next week. We hope you join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.